Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house, you've been hearing from friends and family that an FHA loan may be your best bet. Well, it all depends on who you are, what you want, and your financial goals. So stick around. This video, I'm going to tell you the pros and the cons of an FHA loan and whether or not it's a good fit for you. Let's get into it. So as a potential homeowner out there, when you're shopping for houses, assuming you need to get a mortgage and you're not paying cash, there are a lot of good options. One of the most popular options out there is an FHA loan. Now, there are good things and there are bad things about an FHA loan. Let's start with the good things first. So each mortgage product and loan product is really designed more for the person's financial goals, but really more about their profile, right? How much money they want to put down, their credit scores, their debt to income, all these things. So FHA is a very popular loan because it has a lot of flexibility. You don't have to be perfect. What do I mean by that? Well, you can get an FHA loan on a house with a credit score down to 580 with 3.5% down. Also, FHA only requires 3.5% down. So people like it both because obviously they don't have to have perfect credit, but they don't have to put a lot of money down, whether or not they have it or not. The third big piece why people like FHA loans is these mortgage products are much more flexible than your traditional product when it comes to your debt to income ratio. All that means is debt to income is really how much money you make versus how much debt you have and how much debt you can carry in the future. So FHA allows, a potential homeowner to carry a total amount of debt up to about 55%. It's actually 56%, but let's call it 55% just to keep it clean, where most traditional mortgages want to keep you at 45%, sometimes 50. So it's either an additional 5 or an additional 10% in buying power that you could get by getting an FHA loan, where that wouldn't happen on a conventional loan, things like that. So we've got the flexibility of credit scores and credit profiles down to 580. We have the ability to put down 3.5% on the down payment. We've got the ability to get a debt to income ratio up to 56%, so you get more buying power. And last but not least, FHA loans allow the seller to contribute to the buyer up to 6% seller concession towards the closing cost. So if you're buying a $400,000 house, in theory, you can have the seller contribute $24,000 in closing costs. That's a lot of money. Now, obviously, FHA loans don't have 6% in closing costs, and so people say, well, why is that an advantage if, I'm not gonna need it all? Well, sometimes people need more closing cost than, the product will allow. For an example, a conventional loan with less than 10% down only allows the seller to contribute 3%. So with that contribution in half, when you're buying smaller properties and smaller houses, maybe under $250,000, you need to try to maximize as much of the concessions. But when you get into an FHA loan, let's say somebody doesn't have 6% in seller concessions and actual fees, right? They can get $24,000 from the seller, but maybe the loan only has $12,000. And so people would say, well, what would I need that extra 3% for, the extra money? Well, you have the ability to go in and ask the seller for all the concessions, and then you can use all that extra money to buy down the interest rate. This is a big bonus. And so, if people are shopping around and they can get a deal on a house, they don't always want to take it off the price of the house. It doesn't really do anything financially. Emotionally, it feels like a win, but the purpose of that is to make sure they get a good deal so it affects the bottom line payments. And taking it off the house, in my opinion, does not give the consumer as good of a bang for their buck as it is for a closing cost credit. I stand by that forever. I think the highest and best use of a concession is definitely a closing cost credit, especially for FHA buyers. A lot of these people are first-time home buyers. Some of these people are financially challenged. They don't have money. They don't want to spend all their money. They want the rate and the payment as cheap as we can actually get. And so if you're able to maximize those seller concessions and get all of it, even if we don't need it, we take the extra and we buy down the interest rate, which obviously puts you in a much better position because you got lower rate, you got lower payment, you got less risk, all at the expense of the seller. So these are just a few things that obviously buyers like about FHA loans that I believe are a positive. Let's flip to the backside of that and say, well, what's the negative? What's the downside? Why would a buyer not want to do it? Maybe why would a seller not want to accept an FHA offer? So I want to get into that. So a couple things about FHA loans that seem to be on the dark side of lending that people have a common either misconception or a thought in the public that there's some negative things, and sometimes they are not as strong, but I wouldn't say negative. So let's get into the first one. The first one is, if you're getting an FHA loan and you're in a community property state like Texas, if one person is only applying for the mortgage to qualify, a lot of traditional loans will say, for example, a husband and a wife, and the husband or the wife is the only one applying for the mortgage. All you have to do is look at the person's debt that is applying for the mortgage, and it doesn't matter what the spouse or the life partner has in their name. it's kept separate. The bank never takes it into account, and the mortgage product doesn't require that. So it's just the person that's qualifying with their debt and their income. On an FHA loan, when you're in a community property state, if only one person is using their income and the other person's not on the loan, not only do you have to count the person's debt that obviously is applying for the loan, but any additional debt that that spouse has that's in their name only, an individual car, an individual credit card, you have to take that debt and add it back into the person that's actually qualifying for the loan. Where if somebody, had a $600 car payment, somebody had a $200 credit card payment, even though that person's not on the loan, you have to take those monthly payments, $800, count it back in to the person that's qualifying, and they have to qualify with both their debt and the spouse's debt. So in a community property state, sometimes getting an FHA loan can be a restriction to the buyer because their spouse or partner has additional debts that maybe they can't go on the loan and qualify, no income, no credit score, who knows the why. But because they have other debt, they've got to obviously feed it over to the person that's trying to qualify, and they have to account for all of it, so it can be a restriction on an FHA loan and may not be able to qualify depending upon the community state partner that they're with and how much debt they actually have, so it can be a hindrance. Number two, FHA loans have mortgage insurance. So there's a huge misnomer out there about PMI. So PMI is private mortgage insurance. That is on conventional loans only. FHA loans have mortgage insurance, not private. Mortgage insurance, because it's a government-backed loan, and they are on FHA loans on all loans, where people have this understanding that, oh, well, even if I have PMI or MI on my loan, once I get to a 20% equity position, Brian, won't it fall off? On conventional loans, yes. On FHA loans, no. So one of the downsides about an FHA loan is, regardless how competitive the rate is, and they're usually a little bit better than conventional loans on lower FICO borrowers, you're going to have monthly PMI or MI, as people should actually refer to it as, for the life of the loan. So that can be a hindrance. 20% equity, 30% equity, 40% equity, that MI on FHA loans stays forever. Now, all of our clients that obviously start on an FHA loan, we encourage them at some point in time to get off that FHA loan, strictly because we think we can improve the loan and the financial position, sometimes ideally with a better rate, but also to get rid of PMI. So I don't have too many clients that keep FHA loans for life, but if you did, that MI would never go away regardless of the equity position. I think one of the other pieces, last but not least, are the appraisals. So this is a downside to an FHA loan. What happens on appraisals is, if an appraiser goes out to a property and they appraise the property, they'll appraise a property for the value, they'll appraise the property for the condition, they give that back to the mortgage company, we double check to make sure value's good, condition's good, all these things, and sign off on it. This is a standard practice on all mortgages and all loans. However, with FHA loans, what happens is the appraiser is required to go a little bit deeper on the appraisal on the property, on the condition. So where a conventional loan, a jumbo loan, the requirements for the appraiser to dig deeper through the property on the condition is not there. So let's say there's 3 layers of the property: surface, mid-level, heavy. A conventional jumbo loan only probably has them go to level 1, maybe 2. So even if there's something down there at level 2 or 3, they're not required to dig that deep, so they would never find it. An FHA loan requires them to go to level 3 and do more extensive research and appraiser on the condition to figure out if something's there. So if something is there below the surface, level 2 or 3, they would most likely find it on an FHA loan. It could be an issue, and then the seller could be required to fix it prior to closing, which obviously could be a restriction on the contract and the details and everything, and maybe cost the seller more money having to do repairs on a FHA loan that the buyer is requesting because of the extensiveness of the report and having to go deep on the condition. So a negative is, if they find something on a conventional loan and it doesn't require them to report back or have it fixed, we can skip over it, everything's good, and you can proceed to closing. They are required to go deep on an FHA loan, and obviously a lot of times, 30% of the time I would say, they find things that they wouldn't on a conventional transaction. Now, most of the time they're not big, most of the time they're small, things like wood rot that they may not have to take care of on a conventional loan. But there are some things they've got to dig deeper on: foundation, plumbing, roof, wood rot, lead-based paint, all these things. So again, are there deal killers on them? Sometimes. Would they be deal killers on conventional? 50-50 depending upon the appraiser, but it does cause them to go a little deeper on the property and sometimes report things that have to be fixed prior to close, which obviously can be a little turbulence on the transaction, but it's required. One other big important piece, and I'll leave you with this on an FHA appraisal. So if somebody goes out, let's say a seller, and they've got a house listed at $500,000, they accept a conventional mortgage, they send the appraiser out there, and let's say the appraiser says the property's worth $490, okay? If the buyer and seller cannot agree to, hey, this house isn't worth this, it's $490, we can't find some meeting in the middle concession, the buyer can walk away and say, hey, great, thanks, I don't think your house is worth that. And my seller says it's worth that, we're not gonna budge. And so what happens is they just terminate the contract. Everybody goes back to the drawing board, buyer goes this way, seller lists the house again, and the seller gets another new buyer that comes in. Well, that new buyer probably gonna have a new bank with a new mortgage company, and they're gonna order their own appraisal. And if that appraisal comes back for $500,000 and everything's all good, they can close. So the original appraisal and the second or third or fourth appraisal, however many are needed to make that transaction happen, are not tied to each other. They're independent of the scope of work of the mortgage company, and the appraiser and the guidelines do not require those people to talk to each other to figure out how somebody came in high, how somebody came in low. So it's a little bit cleaner and gives people more of an opportunity. Where on FHA loans, that is not the case. So a lot of people don't know, and sellers don't know this too, which is if they list a house and an FHA buyer comes through and they get an appraisal, and let's say the condition is fine, but the property value is low. They've got a deal at $500,000, that FHA appraisal comes back at $485. And what happens is, let's say again, the seller and the buyer cannot meet in the middle. The seller thinks it's worth $500. The buyer says, sorry, this is the case. They part ways and they go back to square one. That seller can no longer accept another FHA buyer to come in and make an offer on their house, because FHA does not let that next buyer come in and order a second appraisal to see what they think the value is. FHA appraisals stick with a property for 120 days. So if you have an FHA buyer that orders an appraisal and it comes in low and they can't make the deal work, and the seller goes back to the market to list the property and they accept a new FHA buyer, they can't try again. They have to take the old appraisal. And what happens is a lot of sellers don't know that, and they terminate the transaction, and then they go back to the drawing board and they realize the hard way, oh man, I can't get any more FHA people. I've got to lower the price of the house, and I don't want to do that because I don't want to lose money. So now we can no longer accept FHA buyers anymore, which shrinks down the pool of buyers to conventional loans, VA loans, and shrinks down the opportunity for that seller to list their house again, sell it, and make max money with the available people out there, because that FHA sticks with the property. So I hope that was clear, which is FHA appraisals require more from the appraiser, and sometimes sellers have to fix little nickel and dime things that they wouldn't on a traditional loan. Also, if an FHA appraisal is done on a property for a buyer and the property value comes in low and they can't agree, the seller can start over. They can accept offers from as many people as they want with different type of loan types, but if they agree to accept a new offer from an FHA buyer, the previous appraisal that was done, as long as it was with 120 days, has to stay with the property. It's not specific to the buyer. So these are just a few things, pros and cons of FHA loans. There are more, but obviously if you guys are interested in hearing about specifics, you can feel free to connect with our team. So listen, I hope you found this video useful. If you did, do me a favor, share it with somebody, drop a comment below, like this. We want to help everybody as much as we can. If you guys have any questions or just want to talk about a pre-approval, your financial situation, or even get pre-approved, do us a favor, reach out to us, call us, email us, text us. We're always here for you. Until next time, stay tuned.